Mode.
Good afternoon and welcome to today's Premium Account Short Form Market Update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hinde, current Managing Director of Global Equity Management. The format for today's presentation being a short-form webinar, we do a quick summary of the macro outlook driving equity valuations. We look at a select group of stocks within the ASX Top 50 and conclude with a short-term summary of some of our recent transactions, portfolio allocation and Australian share market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Moving straight into the macro picture on the on the XJO, we've had better manufacturing data out of the US. We've got the unemployment numbers out at the end of this week. I have been chatting a fair bit about the global GDP picture and our macro theme that we probably are more of the view that global GDP will start to accelerate over the course of 14 and 15. I think the probability of the US or the Federal Reserve materially pulling back on their stimulus program, any adjustments I think will remain very small until such time as we begin to see European GDP accelerating back up to sort of 1.5–2%, and then I think that'll probably be the catalyst. So the benchmarks for the Federal Reserve are obviously a lower unemployment rate in the US, back down at around 6.5%, but I think that coincides with obviously in improving global GDP picture as well. So I think what we're most likely to see for equity valuations domestically is with us trading on a 15% or 15 times PE multiple, roughly looking for around 6–7% earnings growth into the next year's earnings results, and we'll start to see those numbers come through in February. And a roughly just over 4% dividend yield, the market's fair value. It's hard to sort of find excessive value because we're not seeing a lot of names that are delivering above average earnings growth. Those names that are tend to be predominantly international based businesses with significant US dollar earnings, and they're already trading on a reasonably high multiple. However, that's still where probably we see the bulk of the value in the market is names like QBE, Brambles, Amcor, CSL, Computershare, and I'll look at some of these in a moment. And still defensively with this recent pullback that we've had in the market, Woolworths, Wesfarmers and some of those type of names start to look interesting again. But our base case is that the Australian market largely chops sideways probably through till the most part of sort of March, April in the new year, and then we'll really sort of reassess where things are sort of post the next round of US debt ceiling and budget discussions, post whether we start to see any tapering and whether in fact we actually do start to see better data coming out of Europe, which might support the longer term view that global GDP starts to pick up. All right, on that note, let's have a quick look at a couple of stocks this week. ANZ, so for money that's been freed up from the recent option expiry last week, we start to look at ANZ and Westpac at on near these levels. So the big tailwind that's driven bank earnings I don't think still exists. The headline numbers for banks have looked good because of the reprovisioning of bad loans. That's at sort of, cyclical sort of low levels at the moment, so the prospect of having add backs in for provision loans is diminished. We've seen dividend payout ratios increase, and we're not going to see those same sort of tailwinds. What we will see is hopefully better GDP, better loan growth, but still I think that's probably only going to grow underlying earnings on a true comparison of about 5%. So with the stocks trading down here at about a 5.5% dividend yield, I think they become attractive. I still think the sort of macro conditions are right for bank valuations to move a little bit higher, but I think predominantly it'll be a sideways consolidation. We'll see some lift from these current levels, but not looking for a real quick return to take out that recent high. So our strategy is to own them and then sell the covered calls European style post the next round of dividend, collect the call premium and collect the dividend. The two banking stocks that we're drawn towards are ANZ and Westpac. Most of those comments I provided there for ANZ apply for Westpac as well. In the energy space, we continue to like Origin, albeit the stock is reasonably expensive. Our valuation targets around $14.50 to $15. The stock's trading on about 3.5% dividend yield, on about 16 times forward earnings. The real growth story, probably only look for about 5% earnings growth in the February numbers. Pushing out into 15, we'd look to see Origin return back to its low double-digit earnings growth. AGK, we don't have high expectations coming into the Feb earnings season, probably really flat to maybe 4% earnings growth, but the stock's starting to get attractive down here on a yield basis, so happy to be gradual acquirers of AGK at or near this level. Now let's look at a couple of these US dollar earners. I think QBE starts to look a little more attractive from here as we start to see the prospect of a stronger US dollar and longer-term gradual rate increases in the US should start to underpin QBE, where after sort of a few years of it being in a structural downtrend, we should, in theory, start to see more of a higher high, higher low pattern and gradual earnings growth coming through from QBE. So that'll be one that's on the radar, and we'll take a great deal of notice of the upcoming earnings results. Brambles. So this stock we've owned at lower levels. We've just delivered it under last month's option expiry. I still think at around 5% earnings growth, a beneficiary of sort of a low Aussie dollar helping to, at the margin, improve the earnings. The spin-off of the recall asset, we're happy to continue to look to add exposure to Brambles, but certainly would welcome an opportunity to buy it at slightly lower levels, given that it's trading on about 17 times forward earnings and a low 3% dividend yield. Amcorp trading just above 4% dividend yield. We got the spin-off of the Aurora Australian Flexible business, which will occur in the course of this month. So again, where we own it at lower levels, the company will deliver about maybe 8% EPS growth into February, a slight beneficiary of the lower Aussie dollar. We have taken profit after owning at lower levels, including the call premium, effectively up at around $11.20. So any pullback, back down around $10.50, we start to be aggressive accumulators of Amcor again. But we really, for clients that we've just delivered the stock, we probably won't take another strong look at it until sort of that January period. CSL, with the company buying back further $900 million worth of shares that were not expected. I think this current consolidation has a little bit further to go, but really with the company only growing earnings at about 10%, trading on about 20-odd times earnings, the stock's reasonably expensive. I think the range is somewhere between sort of $67 and maybe $71. I don't see it pushing too much higher than that. Computer shares should deliver about 5 to closer to 10% EPS growth when they report in February. We have owned it at lower levels down here. In some cases, we've just recently taken profit up here around $10.75, $11. I think that caps the upside. I'm more likely to think Computer share really consolidates and tracks sideways. Any opportunity to buy back at the low $10, we would be willing to step back into Computer share. Within the resource space, BHP, for clients that don't own it, happy to accumulate it here. I still think BHP can trade up to around $38.50 to $39 into next year's dividend. So we're accumulating at these levels, selling the covered calls out, allowing for roughly 10% capital growth. And in the event that BHP largely moves sideways, that dividend stream and the call premium delivers in excess of 10%. That's the same story for Woodside Petroleum. We like it down here at these levels. Our target's about 7% higher than where the price is trading at the moment, up at around $39.50. The stock's on about a 5 and a bit % dividend yield, should deliver about 8% earnings growth. I think the outlook still looks reasonably solid for Woodside Petroleum. Woolworths, the recent sell-off that we've had, up here the stock was getting down a dividend yield of less than 4%. The company should only grow earnings about 5 to maybe 7%. That's where the market's expectations are. Based on those forward earnings expectations, the stock's now getting back down to about a 4.5% dividend yield. I think that starts to look attractive. So for money that's rotated out of the market, I really see this as a reasonably good buying opportunity over the next few days. So we'll look to accumulate Woolworths, let it rally up a little bit, and look to sell calls into the early part of the new year at around $35.50. Again, making sure they're European, where we collect the dividend and we collect the call premium, driving roughly 10% cash flow out of Woolworths. The other defensive names that we're looking at the moment, I think Telstra will run up again into the February-March dividend, so we're looking at buying at around $5, around $5.25. I think probably captures the upside potential for Telstra. Wes after trading on a very high multiple, the corrections, doesn't go a long way to address the high PE valuation, but at around 4.5% dividend yield, and I think no prospect of Australian interest rates moving higher anytime soon. I still think sort of there's a wall of money there chasing dividends coming into sort of this February, March period. So again, our base case is these names are expensive. They're likely to trade sideways, but they will perform strongly into the div. So we're buying them on any opportunity of a sell-off and selling covered calls European style further out to collect the div and the call premium. In the property trust sector, so there's a big announcement out today that Westfield Group, which is what has sort of driven the price action here, will combine its Australian and New Zealand assets and merge it with Westfield Retail Trust. I don't think it particularly changes the valuation story. I think Westfield on about a 4.5% dividend yield's worth around $11 to $11.50. I do think its US dollar exposure starts to make it more compelling, and certainly at around 11.50 we'd look to sell covered calls into the 11.75 sort of $12 range. We're looking for it to return up to around 11.40. Westfield Retail Trust at around a 6% dividend yield, really limited earnings growth, close to a 100% payout ratio. I don't see there's a lot of earnings growth or value expansion here in the share price, but certainly could trade down to sort of a 5% dividend yield, so somewhere between 3 and 3.20 I think is the price range for Westfield Retail. So again, through complementing that with a covered call strategy, we're getting 10% cash flow out of Westfield Retail. GPT Group in the news, they're acquiring CPA. I think the hedge funds are shorting GPT and going long CPA. I suspect that'll be covered and reversed post the acquisition, going through at about nearing a 6% dividend yield. As the stock moves down to this $3.50 level, it should be very well supported. So we're looking at being small acquirers of GPT at or near this level. I think we look back in 3 months' time and the stock should be back up at around 375, 380, which will put it back in line with the other property plays. And finally, Stockland Group should deliver about 4 to 6% EPS growth. Certainly the residential property sales data or earnings forecast for the company continue to look strong over the course of October and November. I think that underpins that earnings forecast of sort of roughly 5%, puts the stock on a roughly a 6% dividend yield. The company does pay out 100% of its earnings in dividends, so there's not a lot of scope, I think, for the dividend to increase beyond sort of the underlying earnings rate of the business. So at around sort of 380, I think it's good value. I think it trades higher into the dividend, but really sort of at around 420 caps the upside. So hence we've been owners of it at lower levels. We've sold the covered calls up at 420. For clients that don't own it, it starts to look interesting again back here at around $3.80. And finally, just to conclude, so that takes you through a couple of the stocks that we're looking at just in the week ahead. Next week's recording, I'll sort of do a full summary of the top 50 stocks ahead of Christmas, and then we'll sort of pick things back up again in the new year. But our base case for the Australian equity market is we still think there's compelling value in these defensive names that are growing earnings by around 5%. We don't see that there's a huge amount of capital growth in those names, so we do need to complement the strategy with a covered call, drive that additional cash flow from the call premium and the dividends. We still think BHP, Woodside Petroleum provide opportunity for capital growth. ANZ and Westpac look interesting after this recent sell-off. Otherwise, exposure into these US dollar names on any pullback would create a new buying opportunity. Thank you for listening in, and I look forward to speaking again next week.